Here's what's coming up on today's show.
Right, and people tend to think about life insurance maybe when they've had a health issue.
Oh, yeah.
So it's always better to get life insurance when you're healthy.
Welcome to the How Money Works podcast with Craig and Jennifer Moser of Maestro Wealth Advisors, serving you throughout the Triad of North Carolina for more than 30 years.
So, guys, it's life insurance, man. It's, not everybody's cup of tea, but
raw excitement.
Right, exactly. I can hear it in your voice already.
But we haven't really talked about life insurance in a while. I mean, our show is all about really kind of retirement planning and how to plan for retirement. We talk about the market a lot. Craig, you're a student of the market and really started your career on the stock brokerage side, so you really know that. So I think it's a good time to talk about life insurance. We're at the beginning of the year.
Yeah.
So anyway, that's why this show is all devoted to life insurance.
That's right. It could be a great
So listen up.
There you go. I mean, it could be a useful tool, right? Depending on what you're trying to do, and maybe it's the only tool. So there could be some useful things. So let's talk about it. Let's start with income replacement. Many times I think, Craig, we think about this right when we're younger, when we first have our young families, things of that nature.
Yep.
But I mean, why couldn't that be useful for an elderly person as well, somebody approaching retirement or into retirement?
Well, let's talk about the young person first.
Elderly person, Mark.
Watch
elderly,
yourself, buddy.
yeah.
Hey, I mean, I'm over 50 now. I'm in the pre-retirement stage.
Treading
so.
on thin ice, sir.
I know.
So let's say that you're in your 30s, you're married, you just got the big mortgage because you got to buy a house. You got the 2 car payments, you got the 2 little monsters clinging onto your legs, and so you've got all these expenses, and you both work, have pretty good jobs, so things are going the direction they're supposed to go. You're saving, you're paying off these debts that you had to have, and the kids are still in school and teeth and all that other stuff, and then all of a sudden one of you passes away, because it can happen. Mm-hmm. I had a friend call me one time, and he said, "What are you doing this weekend?" And I said, "I don't know." He said, "Come over and eat with me." I said, "What are we going to eat?" And he said, "Chicken wings and beer." And I'm like, okay. And I went over there, and while we're eating chicken wings and beer, he asked me, and this guy's in his 40s, if I would be a pallbearer at his funeral. And I'm looking at him, and I laughed.
Wow.
He said, "No, dude, I've got pancreatic cancer. I won't be here in 2 weeks." Oh, geez. And I'm like, I didn't have a word to say. I didn't know what to say. Yeah. And I said yes, and sure enough, I was a pallbearer 2 weeks later. So I mean, those are kind of shocking things to say. So we don't know our time and date, but let's say one of you passes away, and you still have the same amount of car payments to make. You got the same amount of house payment to make. The kids still want to go to school and eat food, and you need the money. Well, how can you replace that? Well, life insurance is a very logical thing to use there. Mm-hmm. Before I forget this, a lot of times people come to me, not as much as it used to be, because pensions are kind of going out. But if you have a pension and you're looking at your spouse and you're saying, okay, which one of these pension options do I select? I can select one that pays the highest amount, but it only pays just for my one life. Mm-hmm. I can pay one that will have a reduction, and it will pay me the same amount that it will pay my spouse. But if I die first, that's good for my spouse, but what if my spouse dies first? I could have taken the better one. Right. And then there's a multitude of other choices in between there, and you're going, what do I do? Well, a good tool could be the life insurance. So if your best guess is that your spouse won't outlive you, but you can't take the chance, okay, if you have a fairly significant life insurance policy on your life, if you do pass away first, they get a tax-free death benefit from the life insurance, which can then be used to replace the pension. Mm-hmm. I mean, that's something that if all the stars align, don't take the life pension and then go try to buy life insurance, but take a look at this prior to retirement. Again, that's called planning, and see if that is a viable option for you. And that way you get a higher payout.
Right. And people tend to think about life insurance maybe when they've had a health issue.
Oh, yeah.
So it's always better to get life insurance when you're healthy. I mean, it sounds kind of intuitive, but the healthier you are, obviously, the more insurable you are, because the insurance company doesn't want to pay off, right? They want healthier people, and they reflect that in the premium you pay. So, if you're healthy, that's really the best time to look at life insurance and these options. There are ways to get some insurance if you're not healthy. It depends upon your situation, and that's all through the underwriting process. And you would work with your financial advisor to go through that to find your best option, because not all carriers are the same on that. So that's one way you can use life insurance for income replacement, whether you're young or older in pension. What about estate liquidity, Craig? That's another option to use life insurance for.
Okay. So let's give a couple of examples. Let's say that the estate that you have, you're a real estate investor. So you have a very big single house, and that's basically what the kids are going to inherit. Mm-hmm. Okay. Well, how do they pay off the settlement cost? What if there's taxes? What if there are still fees and expenses? If there's a mortgage on the real estate, guess what? They're not sympathetic. They're saying, yeah, we have a first lien on this house. You know, you guys can inherit it, but we want a payment, and we're not going to let you continue to make the payments. A very simple solution is to use life insurance again to pay that. So if you had a $100,000 life insurance policy that paid to your heirs that are going to inherit the other things, there's instant liquidity. I hate to just say it that way, but it is. And so you should think about, before you drop an insurance perhaps that you've had a long time, is there an alternative use I might have for that insurance, rather than just saying I don't want to make the payment anymore? Or maybe you have a life insurance that already has enough cash value built up in its cash value account to where you don't really have to make those payments anymore, and you still get to keep the life insurance. We look at a lot of stuff like that simply because, when somebody comes to us, it's in the box. People bring a big pile of stuff, and we sort through and get it organized, and then we show you what it would look like under different scenarios. One of them would be, what if I pass away? Well, if there's life insurance there, we add that into the scenario at that date and say, okay, that's what it would change for the survivor's world. So it's important to take a look at and understand that the liquidity to your afterlife doesn't matter to you, but it will matter to the people that have to sort everything out at the end. So having that organized, and especially having life insurance, if you don't have a whole lot of liquidity, would be a helpful thing to have. Mm-hmm.
And I touched on this before on insurance, the way it works. Locking in a lower premium is important, because insurance, does, I guess, there is a cost of insurance based on your health and your age, right? Because as you become older, the premium typically is going to be more. The cost of insurance is more. So as an example, we, the Mosers, bought insurance on our two younger sons when they were, probably 15, 16, because we wanted to put some long-term life insurance in place for them. And, so they had a certain rate. They were in great health, had a certain rate. Well, once they turned 21, we went ahead and had it regraded, because, they're in their prime, athletic fitness and everything. So we got it primo rate, and they're going to keep that rate for the rest of their life. Even if they became a smoker later, or, gained 300 pounds or whatever. So we were able to lock in a very good rate for them for the rest of their life on their insurance.
So the younger you are, obviously, think about how a life insurance is going to run this thing. Or a life insurance company is going to look at you and say, okay, you have, if you are 20, like Jennifer said, or 21, we expect you to live to 86 or 87. Mm-hmm. So the chances, if you're healthy, are very slim that we're going to have to pay off. So we don't have a very high premium. But if you walk in there at 65, what's your life expectancy? If they expect you to pass away at 85, they've got 20 years. So obviously they're going to charge you more. That's the reason why it is. You kind of would pay the same amount over the same amount of time. Mm-hmm. But the difference is what the actual cost is each year. So, premiums are only going to increase as you get older. If you wait and then get sick, you may not be able to get insurance, period, because they don't want to insure that risk. And the other side is that premiums are probably going to be substantially higher than if you were the very healthy person. So getting a policy in place while premiums are more affordable, even if you're unsure that you'll really need it and you have the cash flow, you can always cancel the thing down the road. And lastly, a way to lock a lot of this in is to buy term insurance. Now, you want a particular type of term insurance that has a conversion privilege in it that says, okay, I can change my mind from going term, which has a life expectancy of its own, to some or all of it being in a permanent plan, which I can now keep for the rest of my life and build up a cash value if I want to. So it gives you options. It doesn't require you to make that big decision all up front.
Family wealth, all right? So, Craig, they've made a lot of changes to different things through the last couple of years that make it seem like they're making it harder to transfer generational wealth. Life insurance could be a good tool for that, yeah?
Well, I mean, it's a very efficient tool. So let's say that you have a big estate. So Jennifer, help me a little bit on the exact tax rules here, but in general, right now today, each individual can pass up to about $13.6 million. So you go, well, I'm set. You know, I'm not that big. And even more importantly, a couple can pass that joint amount. I mean, you've got to file a tax return if you pass away, but you could go $27.2 million. So you're going, that exceeds my net worth, or maybe you don't. But in about a year and a half, well, at the end of 2025, we revert back to the older tax schedule. Now, one of the things that's in play right now is the federal estate tax level. So back when this changed, under the president before this one, back when it changed, what happened was they had about a $6 million exemption, meaning instead of 13.6, it was $6 million. So you might actually exceed $6 million. You're going, what was then is not now, but could it go back to that? So you're going, wow, what do I do? Well, you could go ahead and set up some things, and life insurance would be a very good transfer asset. So how do you do it? Well, you could buy a life insurance policy. You could name your heirs the beneficiary. But that life insurance death benefit value is actually included in your value of your estate. So there might be some steps that you need to take. There's something called, and I always say this word and laugh, irrevocable, redneck word, irrevocable life insurance trust. So you transfer the ownership or buy a new policy in this trust. You make payments into the trust. The beneficiaries or the heirs or whomever you decide for it to go to. And every year when you make the payment, they have the right to take that money and spend it, but you tell them you're not coming to Christmas and, you know, you're going to drop your life insurance if you do it. And they usually let the payment stay in there. And then at death, since you didn't own the life insurance, it transfers to your heirs and it's not part of your taxable estate. So it's a very efficient tool to transfer family wealth. But life insurance in general, if you name a beneficiary, the proceeds are tax-free. So that's an important thing to think about. You don't want to have any taxation, and if you remove it from your asset base, then that's a very, very efficient tool to get that money to pay estate taxes on the rest of it, or just to transfer family wealth altogether. Let's say you didn't have much. I mean, there's another thing. We have met some folks and they really didn't have much, but they wanted to pass something on to their heirs, so they bought a life insurance policy. Right. Instant money. I mean, it goes. You're
leveraging your dollars, basically.
Yeah, I mean, nobody wants to make a payment, but the payment is very small in comparison to the payoff.
Correct.
So you've got to look at it that way. We have a lot of business owners in our client base. And so it always comes up. Let's say that you have a child in the business, or a young adult, an adult in the business, and you're the prior owner, and you want to let that business succeed to that child. That's a different agreement altogether, but the succession plan may include something called a buy-sell agreement. Okay? So, all right, if you had a child and you wanted that to go to that child, one of the problems with that is, what if you have more than one child? Well, I want this child to get the business. That's the bulk of my net worth. And the other ones, you just got to get the scraps from the table. No, you can balance that out with life insurance.
That's what I was going to say. It's an equalizer. You can use it as an equalizer.
You're the equalizer.
Nice. I like that.
Okay.
I like that.
All right, here's another thing. Let's say that you don't own that business by yourself. Let's say you have a partner or several partners, and one of them dies or you pass away. What's the plan? Do you have an operating agreement that says, here's the plan?
Right.
So let's just say Jennifer and I, and we weren't married. If I die, how does she buy my family out? Because she doesn't want to be in business with my kids because guess what?
They don't know the business.
And they're not going to work, but they still own half of it. So how does that work?
Right.
Well, what you would do is set up a buy-sell agreement. So it usually is funded with life insurance unless you have a big old pile of cash somewhere you want to let go of. And at my death, she's the beneficiary, and we have an agreement that we've set up the price, which is the value of that life insurance, and she walks over to my family and says, here's the money, you got to give me the stock, and now she owns the business. Mm-hmm. That is a very efficient way to liquidate, to liquidate a partner's interest in your business, and it's perfect for the family because now they have real cash that they can take, and it's in exchange for the stock. It's very easy to do, or the ownership of it anyway. So a very efficient way to do it. And then the other part is, let's look at income. So we have a bunch of clients and they can't put money into Roths. All they can do is 401k because their incomes are way too high. If you were a physician or you were a C-suite type executive and you just don't get many chances to save money with a tax benefit. Mm-hmm. Well, life insurance, if it's properly designed, is an extremely efficient way to build yourself not only a death benefit for your heirs, but a tax-free income stream from the cash value. You've got to understand this because most people squint and say there's some trick. There's no trick. The life insurance company, at least in most of these policies, says, here's how much we want for a premium. Here's what it costs to insure your death. Mm-hmm. If you pay more into that account, guess what? That goes into something that will go into a fixed interest payment, not a very efficient one. It can go into a mutual fund pile, and it can go into this indexing strategy. Pick one of the three and say, okay, the money that's in there in excess of what they want for my death benefit, I can fund for my future retirement. I can also access that money very tax efficiently. Mm-hmm. So you can take the growth out. In most investments, it's LIFO. In other words, you have to pay the taxes on what you made first before you get back to your principal value. With life insurance, it's just the opposite. It's FIFO. And then on top of that, you have very, very attractive loan provisions, which basically say, instead of taking the cash out, I can borrow against that value of that life insurance.
Let's talk about that because we actually had a client that was in Florida. They were selling one residence, buying another. They had a liquidity issue. Yeah. So she tapped into her life insurance policy, borrowed from herself so she could put the down payment on the new house because she's decided she's going to move into a new location, a new house, and she needed that liquidity. So she borrowed from herself. And then once the other house sold, she just paid herself back. And she was like, oh my gosh, I'm so glad this was in place.
She never even thought about it. And it was our idea. I said, wait a minute, right. You have, I don't know, it was like $180,000 that she could access from that policy, and it more than covered her nut that she needed to have to get her there.
And it wasn't put in place for the borrowing capability. It was really put in place for the income stream capability, but it served two purposes for that family. So another good reason for them to have insurance.
And last thing is I always hear, how do I pay for long-term care? Well, if you die with life insurance, pretty easy. You just write the check. But the other side of that is life insurance policies are maybe a little easier to underwrite for the long-term care side. And there are particular features in some of the newer ones called chronic care riders that will allow you to access the death benefit through an accelerated death benefit feature in there, a rider. And it says, okay, if you needed some of the $300,000 life insurance policy that you have, we'll give it to you while you're living under certain circumstances. And the circumstances would be, can you not perform 2 of the 6 activities of daily living according to your doctor? And if the answer is no, you can trigger that rider and access your life insurance while living up to a certain amount. There's some percentages and things. Sort of a rule of thumb would be you can get 2% of the death benefit every month. So if you had a $300,000 policy, you could get $6,000 of it It's not taxable because it's life insurance coming to you. And they write you a check. They don't pay the benefits to the nursing home, so you'd have to write the check to them. But I mean, you have control of the funds, and it gives you yet again another way to pay for all or some of the long-term care features that or costs that might be there.
Right.
Thank you so much for checking out the podcast today. If you have any questions about what we've discussed, remember, you can get a complimentary financial review with the team at Maestro Wealth Advisors by calling 336-448-1086 or go online to howmoneyworksradio.com for other great resources and ways to reach the team. You can also check the show notes of today's episode for our contact information as well. And don't forget to subscribe to the podcast on your favorite app so you never miss an episode. We're on Apple Podcasts, Spotify, Google Podcasts, and all the most popular apps. For Craig and Jennifer Moser, I'm Mark Killian. We'll talk to you next time on the How Money Works podcast.
Craig Moser is a financial advisor and certified financial planner. Securities offered through Avantax Investment Services, member FINRA SIPC. Investment advisory services offered through Avantax Advisory Services. Insurance services offered through Avantax Affiliated Insurance Agency.